COMEX vault inventories have dropped 73% since 2020. The system that was designed to control silver prices through paper contracts is running out of the one thing it needs to function: actual physical metal. And here's the thing, this isn't happening in a vacuum. There's a reason the vaults are draining, and it goes back years. Let's talk about the manipulation that's been proven in courts of law. This isn't conspiracy theory anymore. This is documented fact. Between 2008 and 2016, 8 major banks systematically manipulated the precious metals markets: JPMorgan, Deutsche Bank, HSBC, UBS, Scotiabank, Bank of America, Barclays, and Goldman Sachs. These weren't small players making minor infractions. These were the biggest names in finance, and they were caught red-handed. JPMorgan alone paid over $920 million in fines in 2020. The Department of Justice didn't just fine them, they sent people to prison. Michael Nowak, who ran JPMorgan's global precious metals desk, got 1 year and 1 day in federal prison. Greg Smith, their executive director and top trader, got 2 years. These men were convicted of fraud, spoofing, and attempted price manipulation. The judge called Smith the most prolific spoofer the government has ever prosecuted. What is spoofing? It's when traders place massive orders they have no intention of filling just to move the price. They'd put in huge buy orders to push the price up, then cancel them and sell. Or they'd flood the market with fake sell orders to crash the price, then cancel and buy at the bottom. They did this tens of thousands of times over 8 years. It was systematic, it was deliberate, and it made billions for the banks while suppressing the true price of silver. The other banks paid their fines too. Deutsche Bank paid $30 million. HSBC paid various penalties. Scotiabank's manipulation cost them so much, over $360 million in total exposure, that they completely exited the precious metals business in 2021. When manipulation becomes more expensive than the profits it generates, you know the game is changing. Here's what's critical to understand: that manipulation ended around 2016, and the prosecutions happened between 2020 and 2023. The traders went to prison in 2023. So what happened next? The market that had been artificially suppressed for nearly a decade started discovering its true price. And that's where we are now. Silver has been in a structural supply deficit for 5 consecutive years: 2021, 2022, 2023, 2024, and now 2025. According to the Silver Institute, the cumulative deficit from 2021 through 2025 totals approximately 820 million ounces. That's 10 months of global mining supply just gone, consumed, not replaced. The 2025 deficit alone is projected at 95 million ounces. Some analysts put it higher, around 117 million ounces when you factor in investment demand through exchange-traded products. And here's the kicker: this deficit isn't shrinking. Even though industrial demand has softened slightly in 2025, investment demand has exploded. Money is flooding into silver ETFs at levels not seen since 2020. Why the deficits? Industrial demand. Silver isn't just a precious metal, it's a critical industrial material. Solar panels are consuming silver at record rates. In 2015, solar used about 60 million ounces. By 2024, that number hit 232 million ounces. Electric vehicles, semiconductors, electronics, 5G infrastructure, all of these technologies need silver. Its conductivity, reflectivity, and antibacterial properties make it irreplaceable in many applications. Mine production has been essentially flat. In 2025, global mine supply stayed around 813 million ounces, the same as the prior year. Mining companies can't just flip a switch and produce more silver. Most silver comes as a byproduct of other mining operations: lead, zinc, copper, gold. So even with higher silver prices, if those base metals aren't being mined more, silver supply doesn't increase proportionally. Permitting takes years. Development takes years. The supply response is incredibly slow. Meanwhile, recycling can't fill the gap. Yes, recycling hit a 12-year high in 2024 at 194 million ounces, but that's nowhere near enough to offset the deficit. You'd need recycling to more than double to balance the market, and there simply isn't enough scrap silver available. So you have relentless industrial consumption, slow supply growth, and 5 years of deficits. That's the foundation. Now add in what happened in late 2025, and you'll see why the COMEX system is breaking. In October, silver pushed above $50 for the first time in years. The buying pressure was intense, driven by Indian demand and concerns about tariffs causing metal to flow into the U.S. Then in November and December, silver absolutely exploded, hitting over $83 in December and then surging past $85 in early January 2026. At one point, it touched a new all-time high above $85. Here's where it gets really interesting. Shanghai silver prices started trading at massive premiums to COMEX. We're talking $8 per ounce premiums at times. Why does that matter? Because it shows the physical metal is worth more in Asia than the paper price in New York suggests. When that gap opens up, it tells you the COMEX paper price is disconnected from physical reality. Then TD Securities tried to short silver in October. They got stopped out and took a verified $2.39 million loss. They tried again and failed again. Chinese banks that were short silver faced margin calls and account suspensions. The shorts are getting absolutely crushed because there's not enough physical metal to cover their positions. And that brings us back to the vault drain. December 1st through 4th, nearly 48 million ounces claimed. The registered inventory, the metal available for delivery, dropped to critically low levels. Some data showed it falling below 80 million ounces. Market data aggregators reported backwardation in the futures market, meaning near-term contracts were trading above longer-dated ones, sometimes by significant amounts. That's not supposed to happen with commodities unless there's a shortage. We also saw something unusual in the futures market structure. Normally, traders roll their positions forward to the next month, but in late 2025, traders started rolling backwards, moving from March contracts to January and February. Why? Because they wanted delivery now, not later. They don't trust that metal will be available in March. That's a sign of acute physical scarcity. The CME, which operates COMEX, responded by raising margin requirements. On December 26th, they announced margins for silver futures would rise to $25,000 starting December 29th. Critics immediately called this manipulation, arguing it's designed to force liquidation of long positions and protect the shorts. When you raise margins during a price surge, smaller traders who can't meet the higher collateral requirements are forced to sell. It's a way to cool the market. But here's the thing. Raising margins doesn't create more physical silver. It might slow the paper trading, but it doesn't solve the fundamental problem: there isn't enough metal. And the physical market doesn't care about COMEX margin requirements. Buyers in Shanghai and India, they're paying up for metal regardless of what happens in New York. Let's talk about what this means. For decades, the COMEX paper market has set the price of silver. You could have 100 times more paper claims on silver than actual metal, and as long as most people settled in cash instead of taking delivery, the system worked. The banks could naked short, meaning sell silver they didn't have, knowing most contracts would be rolled or cash settled. But when large numbers of traders start demanding physical delivery, the whole system breaks. You can't deliver what you don't have, and if you're short and can't deliver, you either buy metal at any price to cover, or you default and the exchange forces cash settlement. Cash settlement is the nightmare scenario because it would prove the paper market is a fraud. JPMorgan, the same bank that manipulated silver for 8 years, appears to have flipped. Market data suggests that as of December 2025, JPMorgan held an estimated 196 million ounces in COMEX proprietary and brokerage positions, plus they custody about 517 million ounces in the SLV ETF. If those numbers are accurate, JPMorgan went from being the biggest short manipulator to one of the largest holders of silver. They saw this coming. They accumulated while prices were low, knowing the deficit would eventually force prices higher. The parallels to 1980 are being drawn. That's when the Hunt brothers tried to corner the silver market, and silver spiked to $50. The exchange changed the rules mid-game, restricting trading to liquidation only, which crashed the price. Many in the silver community fear the same could happen now. Could the COMEX just declare force majeure and settle in cash? It's possible. But there's a key difference. In 1980, the Hunt brothers were speculators trying to corner the market. Today, the squeeze is being driven by genuine structural deficits and industrial demand. You can't just make solar panels use less silver by changing exchange rules. You can't force China and India to stop buying physical metal. The fundamentals are real this time. Some banks and analysts who were bearish on silver are now scrambling. Goldman Sachs predicted silver would average $32 in 2025. It more than doubled. Citigroup set targets of 32, then 38, then 40. Silver blew past all of them, and they're now saying it's overvalued above 70, even as it trades above 80. These are the same institutions that benefit from low silver prices. The gap between paper and physical is widening. Some are calling it the Great Divorce of 2026. In Rajkot, India, 44 silver trading firms declared insolvency in late December, with liabilities close to $425 million. These firms were betting on paper prices, and when physical premiums exploded and paper prices whipsawed, they got wiped out. Real businesses with real losses because the paper market is no longer reflecting reality. So, where does this go from here? Several scenarios are possible. 1. COMEX could continue to function but with permanent backwardation and massive premiums for physical over paper. The paper price becomes increasingly irrelevant. 2. COMEX could be forced into cash settlement on a large scale, essentially admitting they can't deliver metal. This would destroy confidence in the futures market. 3. Prices could go much higher to incentivize more recycling and slow industrial demand through thrifting and substitution. But silver is hard to substitute in most applications, and recycling takes time. 4. Governments could intervene, releasing strategic stockpiles or imposing export controls, though most Western governments don't have large silver stockpiles anymore. Analysts at Metals Focus expect silver to hit $60 in 2026, but if the supply crunch intensifies, if more traders demand delivery, if China restricts exports as they've already hinted, prices could go much higher. Some are talking about $100. When you have structural deficits, a broken futures market, and surging investment demand all colliding, the upside becomes very difficult to cap. The manipulation era is over. The criminals were prosecuted, the fines were paid. 2 traders went to federal prison. The banks that manipulated the market for nearly a decade have either exited the business or flipped long. What we're seeing now is what happens when an artificially suppressed market meets real-world supply constraints. For years, silver investors were told they were conspiracy theorists, told that the banks weren't manipulating anything, told to trust the market. Well, the courts proved the manipulation happened. The Department of Justice proved it. The convictions proved it. And now, with that manipulation ended, we're watching silver's true price emerge. The COMEX system worked when people believed in it, when they accepted cash settlement, when they didn't question why there were 100 paper claims for every ounce of physical metal. But belief systems break when reality intrudes, and the reality is there isn't enough silver to meet demand at anywhere near these prices, maybe not even at double these prices. This is why you're seeing the vault drains. This is why you're seeing backwardation. This is why Shanghai premiums are exploding. This is why shorts are getting destroyed. The paper game is ending. The physical market is asserting itself. And when that process completes, silver's price will reflect actual supply and demand, not the whims of traders placing fake orders to manipulate markets. We are living through a historic moment in the silver market. The old regime of manipulation and suppression is over. The new regime of scarcity and true price discovery is beginning. The COMEX may survive in some form, but it won't control the price anymore. The physical market will. And that physical market is telling us silver is far, far more valuable than most people realize. This is exactly what we've been talking about for years. The fundamentals always mattered. The deficits were real. The manipulation was real. And now, both of those truths are colliding in real time. The banks that suppressed the price for a decade can't do it anymore. The vaults are draining. The shorts are trapped. And the price is finally breaking free. Stay informed. Watch the COMEX inventory numbers. Watch the Shanghai premiums, watch the futures market structure, and most importantly, understand that what you're witnessing isn't just a price rally, it's a paradigm shift. The manipulation is over, the crisis is here, and silver's true value is finally being revealed.